Namaste and welcome to another session on accounting of shares and debentures, and we will be covering underwriting in this case. Illustration number 57, it talks of an underwriting assignment agreed by three people, A, B, C, and the issue is over and there is an unsubscribed portion, which is nothing but devolvement, undersubscribed or unsubscribed portion, and how this unsubscribed portion is apportioned between the three underwriters before deciding upon what is their liability, what is the amount to be paid to them, and what the company should receive from them. This is the theme of this problem. And if we understand how the underwriting works and how the gap is distributed, this problem will give a wonderful awareness about the working of the public offer system. Let us take the illustration straight away. Maruti company came out of an issue of 45 lakh equity shares of 10 each at a premium of 2, means 12 is the value. And the promoters took 20% of it, means 20% of 45 lakhs is 9 lakhs is what they took. And what remained was 36 lakhs. Then there were three underwriters who underwrote the issue in the ratio of 3:2:1. Therefore, 36 lakhs was underwritten by them in the ratio of 3:2:1. Effectively, 36 is 18 lakhs underwritten by A, 12 by B, and 6 by C. There was a firm underwriting of 1 lakh shares. Firm underwriting means there is an application given by the underwriter himself stating, I am going to buy so much of shares in my name. He submitted an application for 3 lakh rupees. Then public also subscribed. When public subscribe, their applications will have stamp of the underwriter, or there may not be stamp of the underwriter on the application. If the application has got the stamp of the underwriter, he gets a direct credit in respect of 28,75,000 received marked forms. These are marked as with underwriter's name. That is 28,75,000, and the specification is given. A got 7,25,000, B got 8,40,000, C got 13,10,000. We will give them credit for whatever they received. But between 31 lakh shares for which we received the form and the 28.75 marked, there is a gap. That gap is nothing but applications which are not having stamp of the underwriter. They are common applications. They are not attributed to any underwriter. It has to be shared by these three people because that is also a part of subscription. What we will do is that 2,25,000, which is difference between 31 lakhs and 28.75 lakhs, we will be sharing in the ratio of gross liability. We are putting the base here now. We have been given the ratio of 3:2:1 here. We will once again distribute this in the ratio of 3:2:1. 37,500, 75,000, 1,12,000. Effectively, we have got 31,000 plus 1 lakh shares of each into 3 brokers is 3 lakhs. 31 plus 3 is equal to 34 lakhs. Effectively, 34 lakhs is credited to each of these people like this. We put a total there. Once we put that, we come to know now that the total issue is 45 lakhs. 45 lakhs comprises 9 lakhs which promoters contributed. Then 3 lakhs was contributed. These are all shares. 3 lakhs was contributed by the firm as underwriting by the each of underwriters ABC. 28.75 received from the public with name of the underwriter stamped on the form or link established. There is an unmarked item of 225 which we distributed in the ratio of this. Once we have done this, out of 36, 34 is done. There is an unsubscribed gap of 2 lakhs. These 2 lakh shares is called under subscription, or it is also called as devolvement. Devolvement means it has to be borne by these underwriters to complete their assignment of commitment. How do we do it is the exercise involved in this illustration. 2 lakhs is comprising of, we deduct commitment minus delivery, 18 lakhs minus 9,37,000, 8 lakh 62,000, 185 and 847. From now starts the process of elimination. We eliminate a partner or an underwriter who has already completed his obligations. His obligation was 6 lakhs. He got 14 lakh 47,000, means he has got a surplus. He is eliminated. In that case, how do we deal with his surplus? His surplus is distributed between these two people in their ratio of 3:2. We convert this, we shift this benefit to these two people in the ratio of 3:2, which results in 5,08,500 and 3,39,000. C is eliminated because it becomes nil. Once we do this, we derive the total once again. The total that we get is 354 and 154. Between these two, this person has already, his commitment was 12 lakh shares, 10.15. Now he got 339 from reapportionment. He also becomes negative. Then he gets eliminated and his credit is transferred to A, that is the next stage. And once we do that, there is only one person who at the end has to bear the burden. It is A. A has got now to bear whatever he has committed, 937, and also this gap of 200,000 comes to A only. And this is the stage where the distribution is over. We found out what was the gap. Then we went by the elimination process in the ratio of underwriting, and there were two stages. C got eliminated, then B got eliminated. At the end, it devolved on A. And this is the process of deciding the devolvement or distributing the final deficit. With this, we have come to a stage where we have got the amount of 200 and also their commitment. Now we have to understand one thing. There are three portions in this. Firm underwriting is broker's application. Marked applications, public has already paid the company. Unmarked applications also, public have paid the company. Broker has to pay on his firm application. Therefore, he has got now two things to do. One, devolvement plus firm application. This is the money company has to receive, which is also called underwriter's liability. To repeat, company has received money on 2 and 3. Company has to receive now money on firm underwriting. Therefore, the company has to receive money from underwriters on two heads. One on firm application, second on the net liability, which is reapportioned by elimination. If we proceed, 2 lakhs plus 3 lakhs which we received, 5 lakhs is what the company is supposed to receive. The question asks, compute underwriter's liability in number of shares. Underwriter's liability in number of shares is 3 lakh, 1 lakh and 1 lakh as per details given above. Then we have got the share premium, nature of the value. Compute the amount payable. This is the number of shares. M and N is the number of shares. Value is nothing but the capital value and premium value put together. Therefore, the face value of the shares will be 10 into 5 lakh, which is 50 lakhs. And premium is 2 lakhs. 2 into 5 lakhs is 10 lakhs. Totally company has to receive 5 lakhs into 12, which gives 60 lakh rupees split into capital and premium, and that is the second part of it. Third, underwriting commission. Underwriting commission is paid on the original commitment given. It has nothing to do with these calculations. They committed in the beginning that 36 lakhs is underwritten by them in the ratio of 3:2:1. What is the value? 18, 12 and 6. On that assignment, that commitment, they will be entitled to a commission of 5%. 18 lakh shares, 12 lakh shares and 6 lakhs. What is its value? Into 12 is 18 lakhs into 15, 216 lakhs, 18 lakhs into 12, 140. Sorry, 12 lakhs into 12, 144 lakhs. 12 into 6 lakhs is 72 lakhs. Totally 432 lakhs is the value of the amount with premium. On this, they are eligible for a commission of 5%. 5% of 216 lakhs is 10,80,000. 144 lakhs is 7,20,000. 3,60,000 is 21,60,000. This is answer to compute the amounts payable or due to underwriters. Now they have a liability which has to be paid to company, and they also need to get a commission. Therefore, their liability to the company or dues from the underwriters is whatever is due to them and whatever is due from them. Due from them is 60 lakhs, due to them is 21 lakhs, 60,000. And what is due to the company net is P minus Q. P is what is due from them. Q is the brokerage or commission which is due to them. Net is what they are supposed to pay to the company. P minus Q. Amount payable by underwriters is 38 lakhs 40,000. With that, the problem is solved in its entirety. We have to just make the journal entries. First entry is for allotment of shares to brokers to the extent of 60 lakh rupees or 5 lakh shares. A's account, B, C in the ratio of their liability 36, 6, 12 and 12. Second, they are eligible for a commission of 5%, 10,80,000, 7,20,000 and 3,60,000. Underwriting commission account debit to ABC. Third, net amount has to be paid by them to the company. That is 60 lakhs minus 21,60,000 is 38,40,000. 38 lakhs 40,000 has to be paid by cash. The company receives 38 lakhs 40,000, and that is a thumbs up. This is the stage by which we achieve the result. Thank you so much. Thanks a lot.